Today we continue our discussion on variances, and this time it's direct labor variances. For direct labor variances, we're going to use this exercise. There doesn't seem to be a whole lot of information in here, but I think we will make it work. So it says, compute the labor variances in the following situations. They're giving us the actual payroll, both hours, dollars, and the total. They're giving us the standard direct labor rate, and they're giving us the production, which is the units produced. So let's start with that. So there were 10,000 units produced this month. I like to pull the information out just so that I know what I'm looking at. This problem isn't bad, but some problems have just a lot of words, and sometimes it's difficult to make sure that we understand what we're trying to do. So I always like to do that. Purely optional. Now we need to know the standard direct labor cost. This is 4.2 hours of direct labor per unit at $19.20 per hour. So we'll put that in. If we multiply those together, that's where that other number comes from. See this number beside it, $80.64. It comes from the 4.2 hours required per unit times the direct labor rate of $19.20 per hour. That's how it gets the $80.60 per unit. We can use that later if we want, but we don't have to. Then we need the actual direct labor cost. Here they tell us the 51,600 hours at $18. We multiply those together if they don't give us this total amount, which is $928,800. That's what we really need, but we will need the other as well. So we'll put both of them in there so that we can refer back to it when we're doing our variances. With direct labor variances, we need to know three things. We need to know the actual direct labor cost. We need to know the flexible budget, which is the actual quantity at the standard price. And then we need to know the standard or the budget. With those three pieces of information, we can calculate both ratios, or both variances. We're doing a labor rate variance and a labor efficiency variance. So let's talk about the labor rate variance first. That's going to compare the actual direct labor cost to the flexible budget. Here, the quantity stays the same, just the price is different. So my actual cost comes from, we said up here that it was $928,800, and it comes from 51,600 hours at $18 per hour. For my flexible budget, we want the actual quantity, so the actual quantity would be the 51,600 hours, but we want the standard price, so that's the standard price per hour, because our quantity is based on hours, so we want to make sure that our price is also based on hours. So we're looking at $19.20 per hour. If we multiply those together, we'll get $990,720. Now we compare these two numbers. Notice that the actual direct labor cost is less than the budget. We know that because we can see that the cost of $18 per hour is less than the standard of $19.20. This would make us very happy to pay less than we intended, so that's going to be a favorable variance. The difference between these two is the $61,920, and that is, again, a favorable variance. Variances are never shown with a negative number, not in parentheses, not with a minus, nothing. Always shown as a positive number, and it must have F for favorable or U for unfavorable, depending on if it's a good or a bad thing. Next, we can move on to our labor efficiency variance. The labor efficiency variance is going to compare this flexible budget to the standard. We're going to use the same standard price for both, so we're using the $19.20 per hour, but we're using the actual quantity compared to the standard quantity. The actual quantity being 51,600. We've already done that calculation, which is great. Now we need our standard quantity. This is the one that when we look at the standard, we have two ways to do this. We always apply the standard based on units produced. Notice that we said there were 10,000 units produced. If they give you the standard units, you can pretty much ignore that. At this point, you won't need that for direct labor because we're going to use the units produced. Same thing with material variances. We're not going to use the standard units. We're going to use the units produced based on the standards. So we have 10,000 units, and we can multiply that by 4.2 hours needed per unit times 19.20 per hour. Or an alternative to this would be to take the 10,000 units times the $80.64 per unit. That would be fine as well. Either one is going to give us the same result. So we have 806,400. So that's the 10,000 units times the 4.2 hours required times $19.20 per hour. Or we can take 10,000 times $80.64 per unit. We'll get the same result. My flexible budget is a lot higher than my efficiency variance. So that means this is going to be an unfavorable variance. If I subtract the two, it's a pretty large number. It's 184,320, and it is unfavorable. When we're looking at variances, we can think about possible things that happened. So we paid people less, but perhaps they were less experienced, and because of that, it took them a lot longer to do the work than we had anticipated. So then the overall impact of this, it was not a good choice. If we look at the difference between the actual direct labor and the standard, we can see we still have a substantial difference there. That is not a good thing. Next, we will talk about our overhead variances. We're going to do both variable and fixed variances. We are going to do the variable overhead variances similar to the direct labor, meaning we need three things: actual direct labor, the flexible budget, and the standard budget. We're going to use exercise E for this. We have the information provided here. I'm just going to put it a little bit differently so that we know how to use it. The standard activity, it says, in units was 30,000 units. If we look here, we need to know the variable overhead standard cost. We see variable overhead rate per unit at $4. We need to know how variable overhead is applied, because based on how that overhead is applied will determine our standard. This says per unit, so that means my overhead is applied per unit. If it was a standard based on direct labor hours, then we would need to know that as well. The budgeted fixed overhead is $36,000. They gave that to us in the problem. Actual production was 24,000 units. My actual variable overhead was 88,800, and my actual fixed overhead was $37,200. And we want that to be $1. There we go. Okay, so now we're going to move on to our variable overhead. We have a spending rate variance and an efficiency variance. For the variable overhead cost, we want the actual quantity times the actual price, but in this case, we don't even need to do that because it was given in the problem. My actual overhead was given at 88,800. For my flexible budget, it wants my actual quantity at the standard price. My actual quantity, because this is applied per unit, that's going to be my actual units produced. So we had 24,000 units, and my standard is $4 per unit. So this will give me $96,000. If we compare these two, my actual cost is less than my flexible budget, which is a good thing. So that gives me a variance of $7,200. For my variable overhead efficiency variance, I want to look at flexible budget versus the standard. So my flexible budget is based on the actual quantity. In this case, overhead is applied based on units. So we're using 24,000 units. Since overhead is applied based on units, my standard quantity is going to be the standard activity of 30,000 units times the $4. So this is going to tell me when I applied the overhead, how did I do it? So I applied the overhead, and if I had applied it to 30,000 units, it would be $4 each, which is less than the flexible budget. So this is going to give me, or the flexible budget is less than the standard, so this will also be a favorable variance. So when my number of units is less than I had planned, so it's a favorable variance because it gives me less cost. The last thing I need to do is my fixed overhead variance. In my fixed overhead variance, I only need one thing because I don't have a difference in my flexible budget because it doesn't vary here. So we are only going to look at the actual cost compared to the standard. The good news for us is this is given in the problem. Both of them were given in the problem. And it says our actual fixed overhead was $37,200 and our budgeted fixed overhead was $36,000. All we have to do is subtract the two. We have more cost than we planned, so it is going to be an unfavorable variance. Hopefully this clears things up for you. If not, just ask me for clarification.